session, we're going to talk about the Greeks. We're diving into a super important topic in options. Now, I know it sounds complicated, but don't worry. By the end of this video, you'll understand exactly what delta, gamma, theta, and Vega are and how they can help you manage risk and reward like a pro. So the Greeks are mathematical tools that help you see how your option might behave as the market moves, time passes, or volatility changes. And the first one that we have is the delta. Delta measures how much an option's price will change when the stock price moves by $1. For calls, delta ranges from 0 to 1. For puts, delta ranges from 0 to -1. It also tells you the probability that an option will finish in the money. Here's an example. A call with a delta of 50 cents will gain about 50 cents if the stock goes up $1. A put with a delta of negative 0.60 will gain about 60 cents if the stock drops by $1. Delta also helps with hedging. If you own 100 shares of a stock and you buy a put with a delta of negative 30, your total delta now is plus 70, less risk. Next, we have the gamma. Gamma tells us how fast delta is changing when the stock prices move. A high gamma equal delta changes quickly. Low gamma equal delta changes slowly. Gamma is highest when the option is at the money and drops off as it goes deeper in or out of the money. Think of gamma as acceleration. If delta is speed, gamma is how quickly you hit the gas. High gamma can create rapid profits, but also fast losses. Then you have theta. Theta measures time decay. Every day that passes, your option loses a little value if all else stays the same. Theta is always negative for long options, both calls and puts, but it gets stronger as expiration gets closer. For example, if theta is negative 0.5, your option loses about $5 per day per contract. Short-term options loses value faster. Longer dated options decay slower, but they cost more upfront. So how do you use the Greeks? Use delta to choose how sensitive you want to be to the stock price. A delta of 70 or higher equals strong price movement. A delta of 0.40 to 60 means balance of cost and responsiveness. And a delta of less than 0.30 equals cheaper, higher risk reward. And you use Vega when you're trading volatility. Here's how the Greeks help you manage risk. Okay, I know that was a lot and it probably sounded like a foreign language, but let's recap. Delta is equal to direction and probability of profit. Gamma is how fast delta changes. Theta is your time decay. And Vega equals the volatility impact. The pros use these to build smarter, more balanced trades. Now, in our next lesson, we'll cover how to choose the right strike price and expiration dates for your option strategies using the Greeks as your guide. Click the link in the description bar to sign up for our free Patreon group where I provide tons of resources and give you access to the practice assignment to test your knowledge on what we talked about today. Don't forget to like, comment, and subscribe, and I'll see you in the next video.